Hi, let's talk about investment choices in financial markets. And this video is supposed to help you. It's for with the stock track assignment. Remember, stock track assignment is a financial market simulation, and you're going to be buying stocks and bonds and options and futures, etc. Those we'll talk a little bit about each of those here. They are explained in the chapter one of your textbook. But these charts will help you understand the kind of risk that may be involved with different kinds of investment choices that you make in StockTrack. So first, we're going to talk about just buying something like a stock or bond. You just buy it, just spend the money right now and buy it, and that would be the spot market. So you're buying in the spot market, right? Then we're going to be talking about buying um, based on borrowed money. So you don't put up 100% of the expense, but borrow, say, 50%. Suppose you buy stock worth $100, only $50 of it is your own money, the other $50 is borrowed. And that's called buying on margin. And the current regulation only allow you to borrow up to 50% of your investment, no more than that, right? But with StockTrack, you're going to have um, that ability, but you actually are starting with $1 million. So only after you spend the first $1 million would you be using any borrowed money. But buying on margin actually increases the risk, and we'll look at that. Selling short is actually selling something that you don't have. And this time you're buying the stock, I'm sorry, you're borrowing the stock that you're selling, right? So you didn't purchase it before, so you don't have that in your possession, uh, but you want to sell it um, because, say, the prices are high. You know, we always want to sell at a high price and buy at a low price. So you think the price is too high, you can sell the stock by borrowing shares of stock. And of course, you have to repay your loan, which is in the form of shares of stock, by buying it back later. And so you're hoping that you can buy it back at a lower price, right? And that's what short selling is. So we'll look at the exposure we have with that. Then futures contracts are contracts um, for buying or selling, but at some point in time in the future, you agree to the date, you agree to the price, um, or even quantity, right? And you make all those agreements right now. The price is agreed upon right now, and the transaction will take place later in the future. That's what the futures contracts. Then, then we'll talk about options. And options, that just like the name suggests, it gives you a choice. So it is a contract for the future that you're going to buy or sell in the future, but you also have the option to not do that. If you purchase an option to buy, then you have the choice of buying in the future, but you can choose not to do it, right? In which case, of course, you will lose. You have to pay something upfront to buy an option, and you'll lose whatever amount you had paid. So let's look at the simplest one first. If we look at the spot purchase, and what we're going to do is do a profit loss diagram where any profits and losses from a change in price. So we go from $0 to whatever the current price is. Of course, the price of some anything we buy will change over time. Suppose you buy it at this price we call S, and that's the spot price. And then as the price of that stock goes up, you'll make money, right? And as if it falls, you lose money. So this is a simple spot purchase, and what you see is this is going to be, if the scales on both axes were equal, this would be a 45-degree line, right? Every dollar the price goes up, you make a dollar on whatever you purchase, because you can sell it later for that higher price, right? And if the price falls, you'll only be able to sell for a lower price and you lose money. So this is a purchase, and since you are buying it and holding it, call it your long contract, which is the opposite of short, if you remember. We'll get to that as well. But this is a long spot position, right? One thing to note is that the worst that can happen to a stock's price is that it can fall to zero, right? And then you will lose all of the money that you had invested in it. But it's not like, say, buying a business or owning a business outright as a sole proprietor, because then your business's losses can exceed your investment in the business, in which case, well, you may have to sell your house, right? That's called an unlimited liability feature of sole proprietorship. With stock is a purchase of a share of a business, but with limited liability. So its price can only fall to zero, and no more than that. The price cannot get negative for a stock, which means that the most you stand to lose is the amount you paid for that stock. But if the price keeps going up, you keep making money, and there's no limit to how much the price can rise to, how high can it get, right? Let's look at what happens if we, instead of using 100% cash investment, if we use borrowed money. Well, what would happen is that because when we borrow money, we pay a fixed interest rate on borrowed money. Any losses will be magnified, because we also have to pay that interest. And any gains also get magnified, because interest that we pay on borrowed money is fixed, and so we get to keep more of the gain. So if I only had $50, if I borrowed $50, I'll have to return. This is actually ignoring interest. Say I borrowed $50 and bought $100 worth of stock. Then if the stock price goes up to, say, 100, 110, then I have to repay my $50 in loan, right? And my own investment of $50 returns $60 in total, $110 for the stock minus the 15 in borrowed money, and that means that I gain more. If you look at 60, that's $10 profit on top of $50 investment is a 20% gain. If I put up the entire $100 myself, then the $10 profit would only amount to 10% gain, right? So with margin, both our gains and losses are magnified, right? And you can see that over here. So instead of the stock price going up to 110, let's say it falls to 90, then what happens? Well, if it falls to 90, then we lost $10. And whereas $10 on a $100 purchase, if you put up the entire 100 by yourself, then that would have been a 10% loss, right? But when you borrow money, the lender is not going to take any loss, so you have to still return $50. If you borrowed $50 and purchased $100 worth of stock, and it falls to 90, you have to return the $50 in borrowed money, and you only have $40 left. So $40 or $10 loss on your $50 that you had put up is a 20% loss, right? So that's why we can see that both gains and losses are being magnified with a margin purchase. Okay, now let's talk about selling short. What is selling short? Well, you're selling stock that you do not possess, and the way it is possible is that you can borrow shares of stock from the broker. Actually, the broker facilitates that. It'll come from someone who holds those shares of stock. But you borrow shares of stock and you sell them. And why do you do that? Because you think you'll be able to buy back those shares at a lower price later and return your loan, which is in the form of shares of stock. So suppose you sell it for this S price, the sale price, S. Then, of course, if the price falls, you will be able to buy it back at a lower price, right? And you make money as the price falls. But as the price rises, well, you still need to return those shares of stock, and you may have to buy it back buy those shares from the open markets to return your loan, which is in the form of shares of stock. You may have to do that at a higher price. So if the spot price rises, you start to lose money. And with short selling, well, the biggest problem is that there's potential to lose a lot of money, right? Not just the amount that you had received by selling. Then, of course, the profit, the maximum profit you'll make is if the stock's price falls to zero, right? If the company becomes bankrupt, then you get to keep all of the sale price. And of course, you've done this in anticipation that the price will fall. If the price falls, you make money, right? Because you get to buy at a lower price and return your loan, which is in the form of shares. Of course, the problem is when stock price starts to rise, and it can rise without any limit, right? There's no limit to how high a stock's price can go, which means you have the potential for unlimited losses. And that's why when you sell short, you should be very vigilant and cover your short pretty quickly if the stock price starts to rise. So selling short is very, very risky, and you can't do it. You should not do it if you're just an occasional participant in the stock markets. Right? Okay, now let's talk about futures contract. Well, futures actually started with something called forward markets. Forward markets where two people will get together, a buyer and a seller, and determine what the quantity of a transaction is going to be in the future. And it'll be something like a wheat farmer and a flour mill. They know that they're going to make a transaction when the wheat is harvested, and to basically get rid of uncertainty in the wheat prices, they can agree on what the price should be. And that's the price at which the farmer will sell wheat to the flour mill at some point in time in the future. And so the quantity will be whatever the farmer can produce, right? So quantity is customizable. The price is predetermined. Quantity is also predetermined. And sometimes the quality is predetermined. And the transaction takes place later. So the farmer sells. So this is when the farmer is selling, this is a long forward contract. In that case, come harvest time, whatever the price is, if the price is higher than as right? Then the person who had purchased, which in this case would be the flour mill, will gain. So it's just like purchasing stock in spot markets, right? Actually, this is the forward market. I was looking at the spot market, right? And typically the forward price is set to be a little bit higher than the spot price, because how else can you have wheat? Well, by buying it right now and putting it away or socking it away in some granary or something, right? Which means you'll have to pay the cost of warehousing it. Also, there's interest cost involved, because if you buy it now, you have to spend the money right now. But if you buy it in the future at the price that's agreed upon right now, then you can save the interest on that money. And that's why the forward price is typically greater than the spot price, and that is called contango, right? But sometimes in case of gold or where, for a goldsmith, sometimes having gold at hand to make jewelry is more valuable than not. So buying in the futures market or forward market may actually not be as convenient. So sometimes you'll see in some cases that there's backwardation where forward price is less than the spot price, but typically it's not. Now, going from forward to futures, well, in futures markets, we actually see that there's an exchange. So it's just not anymore just an agreement between two parties, but there's an exchange that sets the price. Actually, the exchange sets not the price, but the quantity and the quality of what will be traded. And then there are sellers and buyers in the exchange that interact and set the price. But in futures markets, the ability of people to walk away from their contract is diminished considerably, because both parties, the buyer and the seller, will have to put up some money in a margin account with the exchange, and every day their gains and losses are adjusted from that account. So it's called marking to the market, and because of that, interest rates do not matter anymore. So the futures price, it'll be typically less than the forward price. That is when forward price is higher than the spot, right? In case of contango. So interest rates will have smaller impact in futures markets. But otherwise, it's just a starting point. The price that will be different. But other than that, being long in futures or forwards looks very much similar to being long on a spot market. If the price rises, the buyer gains. If the price falls, the buyer loses, and the seller gains, right? So now, basically, most of the futures contracts are heavily margined, because you have to put up a little bit of money in the margin account, which will be marked to the market every day. But that's typically 5-10% of the total dollar value of the contract, right? And therefore, whenever we engage in futures market, we actually take on margin purchases or sales. And what that means is that futures contracts are a lot riskier than the spot market contracts. Now look, let's talk about options, right? So an option gives you, just like the name suggests, it gives you an option. And there's two types of option, an option to sell, an option to buy. And there can be buyers and sellers in both kinds of options, right? So we have different names for those options. So a call option is an option to buy. And so you can basically, if there are options on various stocks, those are the most popular options. But you can say, oh, I'm going to buy stocks of XYZ company for $100 a share a month from now, right? And to buy that contract, you're going to need to put up, say, $5 or pay $5 to buy that contract. Um, and of course, later on, what happens is that, let's say that $100 is the X, it's called the exercise price, right? So if the price a month later is higher than X, then of course you can use that contract and buy it at X and then immediately sell it for a price greater than X. So and make money off of it, right? But you had paid something beforehand, say $5 for this $100 contract. So you really only break even when the stock price is 105, right? It's X plus the C, which is the price. So 100 plus 5. And above 100, when stock price rises, you should still use your option and exercise this contract because you're lowering the losses, right? So say the stock price only 103, it paid $5 already. You're not getting back, but by using the option, you can get the stock for 100, sell it for 103, and that $3 profit from that will offset $2 from your $5 cost. In other words, you'll only end up losing $2, right? Sorry, I said that wrong. $3 profit will offset $3 from the $5 cost, leaving you with only $2 in losses. So between 100 and 105, this option will still be exercised to lower the losses, but it's only after 105 and stock price higher than that is when this option becomes profitable, right? Of course, the seller of the option is looking at the opposite scenario, right? And so the seller gets to keep the $5, the cost of the call option, if the stock price remains below X or 100 in our case. And if the stock price rises above 105, the seller will start to lose. Of course, the seller actually has this potential to lose unlimited amount of money. So the price of the call option really depends on 5 different factors, namely how much the stock price moves about, the volatility of the stock price, where the stock price is currently at. So if an option to buy at $100, right? If the stock price is already 105, you wouldn't be able to get it for less than $5 because it's $5 is the current exercise value, it's the intrinsic value. And the reality is that within the next month, other things can happen. So you would probably end up paying more than $5 for that option, right? So it depends on where the stock price is. If the stock price is $80 and the option is to buy it at 100, I'll probably sell for maybe 20 cents, right? Because you're only paying for something that you think it's likely to happen if the stock price rises above 100. Then the chance probably is very small. Anyways, the stock price volatility matters. What the exercise price is, that matters. What the current stock price is, that matters. The interest rate matters, right? And how long there is remaining until the option matures. Is it valid for 1 month or 2 months or 6 months? You can even get year-long options. They're very expensive, but you can get them. So basically, the price of the call option is going to be above the green line, which is what you'll get if you exercise the option right away, right? Why? Because that's the value of this option at this point in time. Say the stock price is 110 and it's a $100 exercise price, then the value of the option right now is $10. You can buy for 100 something that's worth 110. So the value of the option is $10, but because there's a month remaining and the option could become even more valuable, you'll end up having to pay a little more, maybe instead of $10, you may end up paying $15 for it. But the call price, as such, you'll see that the biggest difference is when the option is at the money. It's called being at the money, which means the current stock price and the exercise price of the option is the same. So that's where the premium above this intrinsic value, the green line is the intrinsic value of the option, right? So if the current stock price is S0, then this is the intrinsic value, which will be S minus X, right? And the remaining amount is called time value, and it's simply a name that says that this extra value comes from the fact that there's time remaining before the option expires. All right, the other type of option is an option to sell, and that's called a put option. If you buy that option, you're agreeing to sell at X, right? So if the stock price ends up being less than X, then you get to sell the same stock at X and you make money, right? So, and if the stock price actually is above X, then if you had the stock to sell, you want to sell it in the market for that higher price, and you'll let go of this option, right? You make the choice not to exercise the option, and the price of a put option, like the call option, will be a little bit above its intrinsic value. But for a put option, if the stock price is low, the option price is higher. If the stock price is high, option price is lower. And with the call option, it's just the opposite. And that's the end of this lecture. And I hope all these all these graphs and charts are helpful to you in understanding the various things that you can buy and sell on StockTrack.